Can we start? Uh, Good evening, everyone. Good evening, everyone. I am CA Rinkesh Mamrawala from Surat, Gujarat, a moderator of this webinar. We are delighted to welcome you all in the webinar being organized by CCLEA and NPO Committee of ICAI. It is my pleasure to be a moderator in the webinar on insights on provisions of FEMA on 2nd January 2025 from 5 p.m. to 7 p.m. being organized by Committee on Commercial Laws, Economic Advisory and NPO Cooperative of ICAI. In a short while, we will start this webinar. I would like to apprise you about CCLEA and NPO committee. This committee is focused to encourage chartered accountants to shape strategy and policy that unlocks economic, financial, and social value, while combining analytical foresight with commercial acumen. One of the core areas of this committee is to serve the multifunctional task of analysis, knowledge dissemination, inputs to regulators on policy formulation, to develop and publish technical guidance, background materials, etc., and to create awareness for professional opportunities for the chartered accountants in commercial laws, economic advisory, and NPO cooperatives. Our eminent speaker will talk insights on provisions of FEMA in this webinar, and we hope that the same shall be useful to members. Now it's a time to introduce our speaker of the session, CA Kusai Goawala sir. Sir, CA Kusai Goawala sir is a fellow member of the Institute of the Chartered Accountants of India, qualified in 1986, having 37 years of rich experience. He is a partner of Messrs. GKDJ and Associates. Sir was nominated for 3 years on India's implementation committee of WIRC of ICAI. Sir was also nominated on the research committee of WIRC of ICAI for the year 2021. Sir has conducted numerous lectures on various topics like tax audit, IFRS, Ind AS, auditing standards, ICDS, company law, GST, etc. in the seminars conducted by the ICAI, ICSI, and CMA Institute. Sir was also part of the group which authored or reviewed various publications like the guidance note on internal audit of the automobile industries. Sir was also part of the group which compiled books published by ICAI on Office Management Manual for CF in Practice, Procedural Guidance for Ease in Incorporation of Company, Procedural Guidance for Registration and Modification of Charge, Guidance Note on Audit of Charitable Trust, Guidance Note on Tax Audit under Section 44AB, Implementation Guide on Audit Trail, and Peer Review Manual. Without further any delay, I'm going to giving charge to the sir to conduct the session. Over to you, sir.
Thank you, Rinkesh ji. Thank you, Mayank ji, and the committee for giving me this opportunity of addressing this particular gathering. And my fellow professional brothers and sisters, chartered accountants, a very good evening to all of you, and wishing you a very, very happy new year on the 2nd of January 2025. Well, we are going to discuss on insights on the provisions of FEMA today, which is something which is a very important topic for all chartered accountants, because the FEMA has been a subject matter of discussion in most of the corporate areas. And I have been a privilege of handling FEMA matters since about the day the FEMA has come into play. Earlier, I also handled FERA when it was in its initial stage. And I've seen the transition from FERA to the FEMA. So this is the journey which I will try to take you through. I'll share my experience with you so that you are able to get the feel of whatever is the FEMA's provisions. And 1 minute, I just shared my screen so that you can One moment. Yes, I hope you can see the screen. Now, FEMA to FERA, FERA to FEMA, I will explain the journey which, yeah. Basically, when FERA was introduced, that time the situation was totally different as far as India is concerned. The foreign exchange was scarce, and it was important to regulate the foreign exchange, to conserve foreign exchange. And it was a situation where the government was not in a position to liberalize foreign exchange to that extent. And I recollect during the FERA times, there was a very senior industrialist in Pune, a very senior man and a very disciplined company. Uh, they were, subjected to some scrutiny by FERA authorities, and the senior most MD, I mean the person in the organization, the MD of that company, very disciplined and very senior man, was arrested just for possessing $100 in his custody. So that was the time of FERA, 1973. Today, you all can have in your pockets $2,000 and nobody will question you. So this is the difference between the FERA and FEMA. Everything was regulated. You couldn't do anything. You couldn't do anything with foreign exchange. And India had a tough situation as far as foreign exchange was concerned. It was a situation at times when India had to ship full of gold just to a foreign country to get some foreign exchange to meet their import payment obligations. It was that kind of situation. So FERA was having a different situation. In 99, when FERA replaced FEMA, the objective was different. It was more of management rather than regulation. And India was opening up to the world at large. The international borders were opening up, and the people were wanted to do business outside India. There were many companies outside India who wanted to do business in India. India having a very good market potential. Many foreign companies wanted to do business in India. Indian companies wanted to use the foreign potential to expand their businesses. All this came up in FEMA. So the FEMA 1999 was introduced with a lot of liberalization from FERA angle to a FEMA position, and where a lot of permissions were under automatic rule. You did not have to go to RBI for any approvals unless you don't comply with any of those requirements. If you are in a meeting those conditions, which is given in the regulations, you need not even go to any RBI authorities. You can straight away go to the AD bank and do your transactions of crores of rupees, hundreds of crores of rupees transactions started happening. And that is the transition to FEMA. When we have seen how FERA to FEMA has transited. Now, basically, the FEMA deals with transactions between a person resident outside India and person resident in India. That means a person resident in India and person resident in India, any transaction, FEMA doesn't come into picture. A person resident outside India and dealing with person resident outside India, no FEMA transaction, no FEMA comes into picture. So it's only when there are two sides, when on one side, when there is a person resident in India, and on the other side, it is a person resident on outside India for a transaction, then we have to look at the FEMA provision. Otherwise, FEMA doesn't come into picture. Now, there are two types of transactions in FEMA. One is called current account transactions and one is called capital account transactions. India, to a certain extent, has become current account convertible. Now, what I mean by convertible is that you don't need approvals for current account transactions. Yes, for certain kind of transactions, capital account transactions are still little bit under regulation side. There are rules, regulations, and you have to follow those rules and regulations and comply with it. Current account transactions can be freely taken by any individual, any citizen, any resident in India can conduct this. Now, what is the difference between current account and capital account transaction? We will discuss all this in detail over the period of next 2 hours, but I will just share with you one very interesting point. Let's say, a company in India is importing, let's say, machineries from Germany. Now, we accountants always look at that machines are all assets and capital transactions and not current transactions. We always believe that purchase of raw material is a current transactions and not capital, and whereas machineries would become capital account transactions. But in FEMA, it is not that case. FEMA, it says that even machinery import in ordinary course of business is considered as a current account transaction and not a capital account transaction. Capital account transaction are those transactions where you invest in shares or other way around, other foreign companies investing in shares of Indian company, buying of properties either India or outside India, or any kind of transactions where the assets and liabilities are getting altered, then it is a capital account transaction. Borrowings, ECBs, all these are capital account transactions. Whereas any money being remitted outside India for meeting the maintenance of your children outside India, medical expenditure, all that is considered as a travel. People travel and use a lot of foreign exchange. You don't need to go to the RBI for that. You can go to your bank and just withdraw the foreign exchange as may be required for travel to outside India for a holiday or something. And that is under current account transaction. So a current account transaction is liberalized and opened up to a greater extent. Current account transactions capital account transactions are also opened up, but there are certain conditions, there are certain regulations, certain places that is under approval route, certain cases it is under automatic route. We will discuss all that in detail as to what is an approval route, what is under automatic route, how do we deal with FEMA, this is that. And of course, now again, distinguishing between FERA and FEMA, FERA was a very, very strict draconian law. Any non-compliance in FERA resulted in prosecution, whereas FEMA is more of a civil law. Any non-compliance would first initially result into penalties. There is a 3 times penalty, there is a compounding provision, all these are, we'll discuss that. Unless you don't make the payment of penalty or whatever, or compounding fee or whatever, then the prosecution comes in. Otherwise, just because you have non-complied with FEMA doesn't really bring in any prosecution aspect involved. But in FERA, as I mentioned to you, even holding of $100, that person was prosecuted. So here, this kind of situation is not there. If you are holding some dollars which are in excess of what is required, there is a penalty, but there is no prosecution. So as I mentioned to you, there are automatic routes and approval routes. Automatic routes are those routes where it is whatever is regulated, whatever is provided in the regulation. And if you comply with those regulations, you don't need to go to RBI for any approvals. You can straight away go to the AD bank and AD bank will look at those compliances and they will do the transaction. You don't need, in all certain compliances are post transaction even. So it is not even that you take a pre-approval or something like that. As far as approval route is concerned, where it doesn't fit into those criteria and you still want to go ahead with the transactions, then you need to go to the RBI for approval route. Now here again, let me share with you one very interesting point. There are certain items which are in the prohibition list, prohibited list. Now those prohibited lists cannot even be under approval route. Even if you go to RBI on those prohibited items, the RBI will not give you approvals because it is under prohibited list. No one has their authority to give you approvals on those prohibited items. So we will discuss all those prohibited items also. But where there is no prohibition, but it is not complying with the automatic route, yes, you can go to RBI, take a specific approval and do the transaction. If the RBI deems fit, yes, this transaction can go through, or they might specify some conditions, then you have to comply with those conditions. Now, what is the total framework of FEMA? It has got regulations, it has got circulars, it has got notifications, it has got press notes, it has got master circulars. We will come to that little later. It provides the procedural aspects. Now, let me share with you one very interesting point. FEMA as such is a very small section, small act, 49 sections, very, very small section, small act. If you look at the FEMA section, FEMA Act, it starts with it that nothing can be done. You can't do anything. It starts with that. Okay, it starts, there's no nothing. You can't do this, you can't do this, you can't do this. Only thing they have mentioned after you can't do this, except as provided under regulations. What they have done is they first have closed all the windows and doors, and then slowly the regulations are opening up the windows and the doors. What is permissible. So first FEMA says you can't do anything. Then they said Okay, except what is provided in the regulation. So now you go back to the regulation. There are several regulations in the FEMA book, and each item, like for example, non-debt instruments, then there is a regulation. Overseas investment, there is a regulation. So current account transactions, capital account transactions, all there are regulations and rules which are prescribed under the FEMA, and those rules and regulations will lay down what you are supposed to do. And if you are complying with those rules and regulations, then under automatic route. If you do not, then you go for approval route. And then again, in that also, there is some prohibited items. There, nobody has the authority to give you approvals. That you cannot do. So this is how the FEMA provisions are in. And it is monitored by RBI. It is not that everything is approval controlled, but it is monitored by RBI. That means whatever transactions you are doing are being reported by the AD bank to the RBI. So if they find post facto, okay, what you were supposed to comply with and you have not complied with, AD bank first checks it. Suppose if they also have missed out and RBI finds out, then they start action, or then they will start initiate penalty proceedings, or they will ask you for clarification and all that. And if you are in a position to satisfy them, it's fine. But if you cannot satisfy them, then the penalty proceedings and other things will start. And who are the policing aspect in this? It is the enforcement department, that is the ED. You all know ED. Enforcement department is the department which regulates or controls this particular FEMA provisions. So any non-compliances then goes to the enforcement director. And non-compliance attracts penalty. And how much is the penalty? Maximum penalty can be levied is 3 times the amount involved. Suppose you have done for an investment of 1 crore rupees and it is not in compliance with FEMA provisions, regulations, and you have violated that FEMA provision, then you will maximum pay the penalty of 3 crore rupees. So this is the penalty provisions. But then there could be a compounding also. Compounding is at much lower rate, maybe 5 to 10%. There is no such benchmarking, but it depends on the transaction to case basis, and it is decided by the RBI or ED, depending on the amount of contravention. Now, our agenda today is that, being all chartered accountants, what is an opportunity for CA in this area of practicing? We generally know that chartered accountants have a practice in terms of taxation, GST law. Then there is a company law, or maybe the statutory audit and internal audits. We are all very familiar with this kind of areas. But FEMA is an area which is specialized, and only some few professionals are only specializing in this particular area. And you don't get too many professionals in FEMA practice. I've also seen that there are not many FEMA practicing professionals. But let me share with you. We will discuss this as to why we need to expand our base in FEMA, because as a chartered accountant, even if you are a statutory auditor of a company, you are required to know FEMA provisions. And this particular lecture will definitely give you an insight, because when we are not only handling FEMA practice, you're not having consultancy of FEMA, but you might have a client who is having statutory audit, and there might be certain foreign exchange transactions. And as an auditor, you are supposed to verify whether these are in compliance with FEMA, because how otherwise you can say that the accounts are true and fair. Then otherwise, there are other things also, like for example, in FEMA, at many places it is provided that statutory auditor is required to give a certificate. Now, unless you know the FEMA rules, unless you know the regulations, how can you certify FEMA? We will discuss all this in detail as to what kind of certification a statutory auditor is required to give. Chartered accountant's role is there in many cases in FEMA. So that also we will discuss as to how we have to definitely be afraid about this FEMA law. Otherwise, we cannot comply with those conditions. And when we are doing statutory audit, then we are failing in our duty as an auditor. Now, there is a meaning of non-resident and other key definition we will discuss, and that is the most important starting point. If you don't know who is a non-resident resident, then you cannot really implement FEMA, because that's the first important principle as to whether a non-resident or I'm a resident, and then the provisions of FEMA apply accordingly. Then different types of bank accounts which a non-resident or a person resident outside India can open, what a resident can open. All these are what we will discuss in detail. Remittance for non-residents. What is the permissible amount that can be remitted outside India for non-residents? I mean, you'll be surprised now that FEMA permits remittance of $250,000 up to per financial year per person. Even an individual can remit $250,000 per year as a resident outside India for maybe acquiring property or acquiring some investments and whatever. So that is called a liberalized remittance scheme. So that also is permissible for a resident in India. So per year, per financial year, $250,000, that is approximately about 2 crore rupees every year a person can remit. In suppose there are 2 to 3 people in the family, 5 to 6 crores can be easily remitted outside India to acquire a property outside India. So this is the liberalization that we have seen, which was not there in the FERA. There are 2 types of investment. One is called inbound investment, that is the money coming from outside India by a foreign company investing in India, or an Indian company investing in a foreign entity to expand its business. So these are both the types of investments which we will discuss in detail as to what are the conditions you are supposed to comply. And the last but not least is the compounding and the penalties as to, okay, if you have violated any law, if you have not complied with any law, what are the consequences? So that we will also discuss. Now let's look at, we have discussed about the opportunities of CA for CA in areas of practice. As I mentioned to you in statutory audit, now NOCLAR is very important. That is compliance with all the laws and the regulations we are supposed to check. So reporting and compliance under FEMA is one of them aspects. Many clients are now doing FEMA foreign exchange transaction. Now simple, most simple. They're doing exports of goods. There is under FEMA, there is a requirement that the money, the whatever export goods of services is there, the money of the thing has to be realized within 9 months. Now, if there is no realization within 9 months, then there is a non-compliance of FEMA. There is a reporting. They have to immediately seek extension from the AD bank. And if they have not done it, then it is a non-compliance. And as an auditor, we are supposed to check. They cannot even write off a foreign debt, foreign debtor, because unless it complies with the FEMA provision. So all this auditor should know. And if he doesn't know, and if there is a write-off entry in the books, and if he has reported true and fair, then he is also responsible, equally responsible for non-compliance of the FEMA. So one must know all these provisions when we are doing a statutory audit. Now, when there is an FDI, foreign direct investment, there is an inbound investment, or overseas direct investment, which is an outbound investment, LRS, that is the liberalized remittance scheme for a resident. Certifications are required by a chartered accountant. For example, a form APR is required. It is an annual performance report, which a company who has made a foreign investments is required to file every year with the RBI. Now, through AD Bank, of course, everything has to be through AD Bank. You cannot directly approach RBI. Now, RBI has dedicated all the responsibilities to the AD Bank. That AD is the authorized dealer. That is your bank. And you have to submit all the documents to the bank, and then the bank in turn forwards it to the RBI. So APR is a document which is to be certified by a statutory auditor in respect of any investment made outside India. Suppose, for example, entity has acquired shares of a foreign entity, and they have to fill up one form APR. For example, if there is a March ending 24, so December 24 is the last, 31st December 24 is the last date for filing this form APR. And this has to be certified by the statutory auditor only. There cannot be any other chartered accountant. It has to be statutory auditor who has to certify this form. All the particulars given in that has to be certified. And you must know then naturally what is an APR. We will discuss all that and how do we certify that. Even while doing ODI, overseas investments, there is one form which there is a statutory auditor certificate in certifying whether they are complying with all the conditions, the limits, the net worths, the amount of investment which is within the sectoral caps, within limits, all that, whether it is there within a limit, they have to certify, and whether they have complied with all overseas investment regulations has to be certified. And so naturally, without the certification, overseas investment cannot be made. So now a lot of responsibility and role is to be played by statutory auditor when overseas investment is to be made by one of your client. And I mean, you are statutory auditor of that company. Then apart from this, there is one very interesting principle as far as FEMA is concerned. We all know TDS provisions under the Income Tax Act. Section 195 deals with payments of tax deducted from payments to non-residents outside India. When any payment being made to a non-resident, a TDS under 195 has to be deducted. Now, as far as income tax compliance is concerned, yes, 195 is required to be complied. But under FEMA also, there is one very interesting, very important principle. Any money going out of India has to be, number one, first and foremost, has to be in compliance with the FEMA regulations. That is, we have to see whether it is permissible under FEMA. If not, then you cannot remit money outside India. Okay, if it is permissible under FEMA, secondly, whether applicable tax has been deducted or not, it is the responsibility of the company which is remitting money outside India. And now, how do you satisfy the AD bank? AD bank is not going to believe you that, yes, you have deducted. Suppose, for example, you are remitting 1 crore and let's say there is a tax of, you are deducting tax of, let's say, 5 lakh rupees. Whether 5 lakh is correct, how do you determine? So now that has to come by way of a chartered accountant certificate under Form 15CB. 15CA is the form to be filed by the company, and 15CB is the auditor's chartered accountant certificate certifying the amount of tax to be deducted based on various principles under 195 DTA and all those things that 195 deals with. And you have to, the CA certifies that yes, 5 lakh rupees is the tax to be deducted, and based on this certificate, the AD bank will permit 95 lakh rupees to be remitted outside India after ensuring that this 5 lakh is paid as to the government, and then only 95 lakhs will be allowed to be remitted. Now, if tomorrow, if it is proved that this 5 lakh was wrong and it should be remitted 10 lakhs, then the chartered accountant certifying will be definitely responsible, not only under Income Tax Act, but also under FEMA, because the money has gone outside India much more than what is required to be sent outside India. It should have been 90 lakhs. It should have been, instead of that, 95 lakhs has been remitted. So then he will be responsible. And even under Income Tax Act 195, that means TDS provisions are violated. So again, there will be a responsibility. So we have to be very careful. We should be aware about what are the provisions of 195. We should be aware about the provisions of FEMA and how we have to work out the tax deduction at source. Now, there could be advisory in respect of FEMA compliances, because a lot of times the clients are not aware about how the foreign exchange management. And I will be surprised to know that many resident individuals who go out of India do not know that they cannot continue to hold resident bank accounts. They have to convert that into non-resident bank account. And when they come back out from outside India into India, settle down, and they forget to change their NR account to resident account, and that continues for time forever. And then later on, it comes out by way of a penalty from the RBI. Notice comes from RBI. So we have to continuously update them and inform them as to what are the requirements of the provisions of FEMA. Implementation of FDI, FCTRS, ODI, all the procedural aspects. When you want to do a foreign investment, then there are a lot of procedural aspects, like you have to file certain forms with the RBI through AD Bank. Then there are certain, of course, these are all online forms, except APR, which is a manual form. Most of the forms are all online form which we have to file. We will discuss as to how the forms are to be filed. FCTRS is another form. ODI form, that is overseas investment form FCS to be filed. Then a chartered accountant can definitely contribute in terms of valuation of shares, because we are expert in that valuation of shares, working out under the discounted cash flow method, which is the FEMA's accepted method of valuation is discounted cash flow method. Under income tax, there is 11UA, but that is for income tax. But for the FEMA, it is discounted cash flow method and not 11UA. Compounding and representations before RBI. Suppose there is some violation a client has done, and you have to make a application to the RBI or to the ED for compounding of applications. Appear before the RBI or before the ED for any compounding applications, or if there is any penalty proceedings, adjudications, yes, the chartered accountants can appear before the adjudicating authority and plead their case for the client. So this is also one of the areas which a chartered accountant can. But for that, you need to know the law properly. Unless and until you don't know the law, how will you be able to argue the case for the client? Now, meaning of non-resident and key definition. This is very important, because unless you know what is the non-resident and resident, you cannot really implement them. So now, in as far as income tax is concerned, we know there are 3 types of status as far as residential status is concerned. We know that is the one resident in India, one is a non-resident in India, and resident but not ordinary resident. In FEMA, we do not have resident but not ordinary resident. We have got two main status. One is a person resident outside India and person resident in India. Okay, now as far as person resident outside India is concerned, again, there are different categories. One is a non-resident Indian. That means a citizen of India who is person resident outside India, he has got some special privileges. So other than a pure foreign citizen who is a resident outside India, and compared to a non-resident Indian, a non-resident Indian gets more privileges, more benefits compared to a pure foreigner who is staying outside India. So there is a distinction when there is a person resident outside India, whether he's an NRI or he's a pure foreign citizen. Now, there is also one more category under a person resident outside India called overseas citizen of India. Many times, Indian citizens go abroad, then they give up Indian citizenship, or maybe they have a dual citizenship and they acquire the citizenship of a foreign country like US citizenship or some other UK citizenship or other countries' citizenship. Now, when they acquire this foreign citizenship, they become overseas citizen of India. Earlier, this term was different. This term was person of Indian origin. Matlab, they are citizens of US, but they had roots in India. Their parents or forefathers, grandfather were at any point of time citizens of India. They might have been born outside India and acquired citizenship from the birth, but their father or grandfather was a citizen of India at any point of time. They get a status of person of Indian origin. Now that person of Indian origin has been removed, and instead of that has been replaced by OCI, overseas citizen of India. Now, what is the difference? Earlier, a person of Indian origin did not require any registration. It was only by way of this position or status. Okay, either he at any point of time held a Indian passport and then surrendered that passport and became US citizen, or even if he never had Indian passport, but his father or grandfather at any point of time had the Indian passport and then they settled down in USA and his children also became US citizens by birth or whatever, then that person also became person of Indian origin. So he did not go for any application or registration or anything. By default, he became a person of Indian origin. But later on, this particular situation was misused. The government came out with a new category. Then the old category was removed from the FEMA and a new category was introduced called overseas citizen of India. Now, under overseas citizen of India, they have to apply for a citizen, for a OCI card. You have to apply through the passport, that module is there. In the passport module, they have to, whatever, apply online for a passport, the same module, you have to apply for an OCI card. Now, the advantage for that OCI card is that the person, let's say, is a US citizen or any other country citizen, when they come to India, they don't need a visa. They just have to flash their OCI card and they can enter India without any visa. Apart from this, a person of Indian origin or OCI can acquire property in India. Any foreign citizen, pure foreign citizen who is not a person of Indian origin or who does not have an OCI card, will not be eligible or entitled to buy property in India. There are certain exceptions, but that we will not get into that. We are going for a normal way because there are so many such conditions and all those kind of things. We cannot, in 2 hours, we cannot discuss the entire FEMA law. We can only do a broad understanding insights of FEMA, which I am going to discuss today. So, as I mentioned to you, there are 2 main categories: a person resident in India, person resident outside India, and within person resident outside India, there are 3 subcategories, which we have discussed. Now, let's look at the definition of person resident in India. It is very clearly mentioned that a person who is not a resident in India will be considered as a person resident outside India. So, it is very, very clear. So, first you have to understand who is a person resident in India. See, in income tax, mainly the status is based on a number of days stay. Intention is not really important. It is a number of days stay. Initially, income tax definition was very simple. Little bit of complications have been added. We all know section 6 and all that. It has been complicated, but then we are not getting into that. We are not dealing with income tax as of now. We are dealing with FEMA. And FEMA sections have remained same. There has been no change in the definition provisions, but I will explain you in very simple terms as to who is the person considered as resident in India. So anybody else other than this will be a resident outside India. Now, a person who has stayed for more than 182 days in the preceding financial year will be considered as a resident in India. But then there are exceptions. As I mentioned to you, FEMA earlier initially only had intent. That means if you are taking an employment abroad, you are going for business outside India, or you are doing staying outside India for uncertain period, then you are a non-resident. But then this number of days has been added later on. So 182 days condition was been added. And now, so if he is in preceding financial year, if he has stayed for more than 182 days in India, he will become a resident in India. But again, there are exceptions. Suppose, for example, Mr. A, who has been staying all along in India, okay, up to, let's say, March 25. Let's say March 25, he has been staying in India. Suddenly in April 25, he leaves for maybe UAE or US or Mauritius or wherever outside India for an employment. He's taken an employment outside India. Okay. Now, if or he has gone out of India to set up his own business outside India, or he has gone to his, suppose he's a retired person and his children are all staying outside in US, and now he decides, okay, I want to stay with my children. He sells off all his assets here and lock, stock, and barrel. He shifts to US. He said, now I want to stay and retire out in US. And he has got a long-term visa over there and whatever that children are worrying. Now, in that situation, when he has gone out of India in April 1st, let's say, on that day, he becomes a person resident outside India. Even though in the preceding so many years, he has been in India for 180 days or more. But the day he moves out of India for an employment, for business, or for an intention, which is for uncertain period, stay outside India for uncertain period, then he becomes a non-resident or a person resident outside India from the day he has moved out of India. So he doesn't have to comply with number of days and all that. He simply, his intention now then plays an important role and not the day. And other way around, if a person who is outside India for so many years comes to India and takes up an employment in India or sets up a business in India, or he has come down to settle in India for good. I mean, now I'm not going to leave India and I'm going to settle down in India. Intention again. Then he becomes person resident in India from that day. So earlier period, last year, he might be full 365 days he was outside India. He was never there in India. So 182 days does not count. But since he has come to India in, let's say, in April 2025, and now he has taken up a job in India, he becomes resident from the day he has come in. Let's say he has come in India on 18th of April. From 18th of April onwards, he has become a person resident in India. Now, here there is no concept of financial year. It is a concept of from the day he has come in. So any transactions up to 17th of April will be considered as a person resident outside India. And any transactions after 18th of April, he will be deemed to have been done as a resident in India. So what? After 18th April, he cannot do any transaction which was only permissible to a person resident outside India and not permissible to resident outside India. And prior to that, he cannot do a transaction which is permissible to resident, but permissible only to resident. So that he has to take care. Okay. So this is the important aspect of residential status. Any person or body corporate registered or incorporated India de facto becomes resident in India. It will not be irrespective whether the entire director, the entire 100% shareholding is outside India, doesn't matter. Even if they're in India, in income tax, there is the concept of place of effective management, whereas in FEMA there is no such concept. Even if the 100% board of directors are non-resident directors, but the company is incorporated in India, it will be considered as a resident in India. So irrespective of who are the shareholders, who are the directors, doesn't matter. So long as the company is incorporated in India, then it becomes a resident in India. Any office, branch, or agency in India owned or controlled by person resident outside India will also become a resident in India. That means there is a foreign company, but it has opened a branch in India. That branch will be considered as a person resident in India, and all provisions of FEMA applicable to resident in India will be applicable to that branch office and not applicable to a non-resident. So, and if there is a branch or office outside India of an Indian company, will be considered as a resident in India. That is again one very interesting. Now, as I mentioned to you, OCI, I have already explained to you that overseas citizen means an individual resident outside India who registered as an overseas citizen of India, card holder under Section 7 of Citizen Act. So it is coming from the Citizenship Act. Under Citizenship Act 1955, a person eligible under the above to become citizen of India, child or grandchild of citizen of India. That means, suppose my father or grandfather were citizens of India, then I am eligible for getting OCI. A minor child or a parent where any parent is a citizen of India, foreign spouse of a citizen or OCI provided marriage. Now, this is very interesting. Suppose a person has gone outside India in US, marries a foreigner. He's got no connection with that lady. I mean, he or she has got no connection with Indian roots and no roots in India. The pure foreign citizen, pure US citizen. And this person, he or she marries that person over there. Now, that person will also be eligible for OCI cat. Now, condition is provided the marriage has been subsistent for 2 years. After 2 years of marriage, yes, they have not separated or they have not divorced for 2 years. Then their marriage continues, and after that, that spouse will be eligible for OCI card. Otherwise, no. And there is one more very important thing. Suppose a person goes to a country which is a neighboring country like Pakistan or Bangladesh and settles there and gets a citizenship of that country, that person will not be eligible for OCI card. So even though the roots in India, they were citizens of at any point of time in India, but since they are citizen of a neighboring country, they are not eligible for OCI card. So this is an exception to the OCI rule. Now, as I mentioned to you, person going out of India for employment, for business, for long-term uncertain stay, what are they supposed to do when they go out of India? What is the requirement? See, I will tell you, many of people who do not even know what they are supposed to do. They just leave India, they go take up a job outside India, and they leave all their bank accounts, everything like that, the way it is. And it is not right. They have to immediately, the moment they are leaving out of India for an employment, for business, or for uncertain period, then they have to intimate their bank in writing and take an acknowledgement and ensure that their resident bank accounts get converted into non-resident accounts. It could be either NRE account, it could be NRO account, or any other permissible FCNR or whatever accounts are permissible, they can do it. Now, again, this kind of NRE, NRO accounts, only certain people can open. Like, for example, any citizen of India can open NRE and NRO account. A foreign citizen cannot open NRE account. Okay? So these are some conditions which we will have to look at. Now, what kind of bank accounts one can open? As I mentioned to you earlier, non-resident external account, non-resident ordinary account, foreign currency non-resident account, and a special non-resident rupee account. Now, we all know in income tax that any interest on NRE account, FCNR account is exempt from income tax. So any income accruing on that is not taxable. NRE and FCNR balances are freely repatriable. Balance in NRO account, which is a non-resident ordinary account, can be remitted out of India for a non-resident, not for a resident. Resident cannot remit. Resident can only remit $250,000 per financial year per person under liberalized remittance scheme. But a non-resident person can, if they have a balance in NRO account, they can remit up to $1 million every financial year out of their balances in NRO account. Now, let me explain you a difference between NRE account and NRO account. You all must have known what is NRE and what is NRO. But the way, I mean, people who have heard me, I always go to the concept of a particular thing. I just don't want to bombard you with technical things so that you will forget after this lecture. No, that is not the intention. I want you to remember for life. That is the objective. So now I'll explain you this difference from NRO and NRE in such a way that you will never forget for life. Okay. We all travel by, international travel. We all do international travel. So whenever we go abroad, we have to pass immigration. Correct? When we pass immigration, a stamp is put on our passport called exit stamp from the Indian immigration authorities. We are then in the gate area where we are waiting for our flight to board. Now, technically, we are outside India because our passport has been stamped as exited. That means we are out of India. But physically, we are in India because we are still breathing the air of Indian space, and we are still waiting for our flight. We are at the airport. Now, similarly, NRE account is something which is outside, which is after the immigration area, and it is technically out of India. That account is technically out of India, but physically in India, because that account is with your bank in India. Any bank will open, any Indian bank. Let's say you go to Bank of Baroda, you go to State Bank, or any bank you go, and they will open NRE account. So it is physically in a Indian bank, Indian shores, but technically that account is out of India. The reason I will tell you. Any money lying in the NRE account, you can remit out of India without any question. No bank, no person in the world or on the earth can stop you from remitting any money which is lying in NRE. That means when you have crossed the immigration, you can travel anywhere in the world from that gate, and nobody can stop you, provided you have a ticket. You can travel anywhere. No immigration officer or nobody can stop you. You cannot travel. Yes, whatever they can do is they can stop you before immigration. They cannot stop you after immigration. So NRE money is cleared of immigration in terms of that. Now, we also know sometimes we transit from one country to other country, and then there is in between one country where you transit. So let's say you have come from New Zealand to Singapore, and from Singapore you are coming to India. So Singapore is a transit point. Now, you have not entered the immigration office of the immigration of Singapore, because you don't need to enter Singapore. You don't have the visa for Singapore, and you are in that transit lounge. The same is the NRE account. You are in the transit. That means any money coming in from outside India can freely go out of India. No questions asked. Nobody can question money in NRE account. Now, suppose there is one, now NRO account. What is NRO account? NRO account is the person who is before the immigration, does not pass the immigration, is before the immigration. That means any money which is there in that account, when it has to go out of India, it has to clear the immigration. Like any person who is before is still waiting for immigration, he has to get that immigration cleared. That means the passport, that immigration officer is going to ask him, where is your visa? Where are you going? Why you are traveling? All that questions he can ask. And you have to satisfy him, and then only he's going to put a stamp of exit in your passport. So NRO money is something which is before the immigration. And it is not freely repatriable. It is subject to conditions. Now, as I mentioned to you that there is 1 million allowed, how do you do it? Now, what is this immigration? Immigration is Form 15CA, 15CB, as well as other forms which are required to be filed with the AD Bank for money to go out of India. Whereas in any NRE account, no need for 15CA, 15CB. Money lying in NRE account can go out of India without any forms. Okay, so this is the difference. Now, let me explain. Now, there is some money which is lying out in India, and that money wants to go to the NRE account. There is a local money. Suppose there is a person who is a non-resident and he has got an NRE account. He earns some rental income in India. That means the money is Indian income. It is not a foreign income, Indian income. And that Indian income he wants to deposit in NRE account. Now, this NRE money, as I told you, NRE account is outside the immigration. Now, the rent income is before the immigration. It has to clear the immigration to enter NRE account. Now, how will it go to NRE account? He has to file that Form 15CA, 15CB, because he has to justify that whether the tax on that rental has been paid or not. Once it is paid, then only that money can go into the NRE account. So that he has to clear the immigration, and then it goes into NRE account. And after it has reached NRE account, then it can be freely transferred anywhere in the world he wants. So then no further inquiry. Okay, so this is what it is. And even yes, when the money has to go from India to NRE account, it has to comply with all the FEMA regulation, whether that money can be remitted outside India or not, repatriable or not. If it is not repatriable, it cannot go out to NRE account also. So this is the thing. As far as NRO account is concerned, any money it is always before the immigration. So any money going out of India has to pass through the immigration, that is 15CA, 15CB, has to comply with the conditions of FEMA, whether it is repatriable. And only when you comply with these conditions of FEMA, then only the money can be remitted outside India. Otherwise, it is not allowed to remit. And any money coming into NRE account from outside India can straight away come to NRE account, no questions asked, because it is outside India in any case. So this is the difference between NRE and NRO account. As far as foreign currency non-resident account is concerned, it is also similar to a non-resident NRE account. But the only difference between NRE and FCNR is that the NRE accounts are designated in Indian rupees, whereas FCNR is designated in foreign currency. Now, how does it help? When the money is designated in Indian rupees, when you want to remit out, you have to convert that into a dollar. So then what happens is you lose out on that exchange difference, fluctuation. Whereas when the money comes into NRE, the dollar gets converted into Indian rupees and it is designated in Indian rupees. Where in case of a FCNR, the money does not change the color of that currency. It can still remain in dollar, and again it can go out in dollar, so you don't lose out on that exchange difference. Suppose when you bring money into India, it can be at 84 rupees, and when you want to remit out India, then it can be at 86. So you lose out on the exchange rate of 2 to 3 rupees of the difference. So that is saved if you are keeping the money in FCNR account. So these are as far as the bank accounts are concerned. Now, remittances, as I mentioned to you, current account remittance is permissible, dividend, interest, rentals, other income of a non-resident Indian, freely repatriable, no questions asked, of course, subject to payment of taxes. If your tax is not paid, you cannot, like I told you, 15CA, 15CB is required before you transfer this money to either to NRE account or directly remit outside India. Both are allowed, but of course, subject to payment of taxes. Otherwise, you cannot remit money. Remittance of assets, sale of property, sale of security, this will come under 1 million scheme. Okay. So if there is any property being sold, then there is again non-debt remittance account which you can use. I will explain in detail little later on that. Current account. Now, current account also, there are certain regulations, certain rules. Current account rules are there. Permissible current account transactions. Now, let me just, before I go into this, there are, as I mentioned to you, there are regulations and rules. Now, who forms regulations and who forms rules? Regulations are formed by the RBI. They make regulations. Rules are made by the central government. Rules are basically more of a procedural aspect as to how we are going to do it. And regulation is what you can do. That is what is given, and that is the RBI's prerogative. So permissible current account transactions, Schedule 1, all prohibited items like lottery, those other things which you cannot, gambling and all that, you cannot remit money outside India for those kind of things, anything which is prohibited. Restricted list with permission, Schedule 2. There are certain items where there are a lot of restrictions, and those you've got to take permission of the respective ministries, and then only they will permit you to remit money, otherwise not allowed. Schedule 3 is list with limits. So, like for example, consultancy fees not more than 1 lakh USD per year. Maintenance of close relative you can remit. Gift from a resident to non-resident maximum is USD 2,50,000. You cannot give more. I will give you one classic example, practical example. In some place, somebody had done it. There was a father who was a resident in India, and a very wealthy father, and the daughter also was very equally wealthy and staying abroad in US studying. And the father wanted to, give some, send some money to the non-resident daughter. And somebody had advised that father that you can remit up to 1 million to a non-resident, can remit up to 1 million. So what the father did, gave a gift of almost about 8 crore rupees in her local account, in her account. And she wanted to remit the 8 crore rupees outside India under 1 million scheme. Now, then they somehow referred this matter to us, and we said, no, you can't do this. Yes, she is permitted to remit 1 million USD, but not, the source is not correct. The source cannot be gift of 8 crores. The gift cannot be more than $250,000 from a resident to non-resident. She can have other income. She can have other assets. Suppose if she has sold some other personal assets and accumulated 1 million, yes, she can send it. But maximum gift that a resident can make to a non-resident is $250,000 in a year. You cannot give more than that. The moment you exceed that, then you are violating FEMA. Medical expenses as per estimate of hospital. There is no limit, because when you do medical treatment outside India, it is very expensive. So whatever estimate the hospital is given, based on that, you can remit money outside India. Educational expenses are higher of the fees stipulated by the university or USD 30,000 per academic. So that also the government is permitting you to remit money out for education. And now it is higher. Generally, we know we always seen the lower of it. Now here it is higher. If the estimate of fees is let's say $1 lakh and 30,000 is another limit. So we can remit up to 1 lakh. If the fees are 20,000, you can remit up to $30,000 because for expenses and all that. So that also the government is permitting you to remit money for education. Now, remittance under 1 million scheme. Only non-resident and OCIs are eligible to remit money under this scheme. So non-resident Indian, now just imagine this. You cannot have a foreign citizen remitting under 1 million scheme. So it is only foreign citizen, of course, OCI. OCI is allowed. But if it is a pure foreign citizen, not allowed. So that is the reason what I told you. Non-resident Indian and OCI get some privilege compared to other pure citizens, pure residents, pure foreign citizens, and that is the advantage. And can remit up to USD 1 million. That is up to, as of now, it's 8.5 crore approximately. It is 84 rupees or 85 rupees per dollar from NRO balances during one financial year. That means suppose in March you have remitted 8 crore, in April again you can remit another 8 crore because the new financial year has started. It is not a 1 year as such, not 12 months. It is financial year. To be remitted from the same account. You cannot have multiple NRO accounts. Because the reason why, see, I always believe in the concept why. So you should understand why this is provided that only one account, because the bank can monitor. Otherwise, what will happen? They will use 5 different bank accounts. एक स्टेट बैंक से भेज दिया 1 million, दूसरे स्टेट बैंक, दूसरा बैंक ऑफ बड़ौदा से 1 million भेज दिया, तो बैंक will never be able to control. Nobody will come to know. So it's only one bank account you can utilize for remitting, and you have to give a certificate. Yes, this is the only bank account I'm using, and I have not made any remittance for other bank accounts. And all this information is being provided to the RBI on a regular basis. And if they find that the same PAN number, same person's name has remitted from various different bank accounts, then you are liable for penalty. Source of funds to be specified as to what is the source of the funds. Source of the funds, as I told you, gift maximum is 2,50,000. You cannot be more. As I have already mentioned, that cannot include gift which exceeds 2,50,000. Sale proceeds of assets are allowed. The remittance should be net of tax. Again, here, as I told you, NRO. So when remittance from NRO, that means you have to comply with 15CA, 15CB, immigration karna hai, uske baad hi paisa ja sakta hai. And there are a lot of declarations being given for 1 million that yes, there is only one account. I have not exceeded 1 million. The source is as per compliance with FEMA. All this you have to give declaration, and then only the bank will permit you to remit money. Now, acquisition of property in India. Now, earlier, there was a separate regulation governing acquisition of property in India. Now, there is a combination of various things in one particular regulation called non-debt regulations or rules. And that non-debt regulation covers any inflow of money for acquiring shares in Indian company, convertible debentures in Indian company, or a convertible preference shares in Indian company, a security which is not a debt base. Okay, and also it also covers properties, and also it has got other types of investments also, like investment trust, REITs. All those things also are covered under this particular non-debt regulations. Then there are various alternate investment funds. All these are covered under this particular non-debt regulation. So they have again specified very clearly. Now, see, one very interesting thing about FEMA is that the regulations are so crystal clear that once you read that particular regulation, you will know exactly what you are supposed to comply with. There is no ambiguity. There are no two different kinds of opinions. कि ऐसा कर सकते हैं, ऐसा नहीं कर सकते, ऐसा हो ही नहीं सकता. It is so very clearly elaborated कि ये करो, वो करो, ये करो, ये करो, ये मत करो. Simple. So it is very clear in clear English. It is mentioned what you are supposed to do, what you are not supposed to do. And if you very simply comply with it, you are within the framework of law. As I said, only NRI and OCI allowed to acquire property in India. Any foreign citizen, pure foreign citizen, cannot acquire property in India. There are certain exceptions we will discuss a little later after this. So NRI, OCI is allowed to acquire property. Now, again, there is a restriction here. Any non-resident person, non-resident Indian or OCI, can acquire a residential property or a commercial property. It cannot acquire under any circumstances agricultural property. That there is a restriction. Now again, why? The government wants to control the property, agricultural land, and because India is an agricultural economy, and they want to control this agricultural land in the hands of local people. They don't want to give it in the hands of the outside India, non-resident Indian. Even they are Indians, but still they don't want to give control to person resident outside India, because that will, the moment they open up agricultural land to a person resident out in India, the prices will go up of agricultural land because there will be a demand, and then the prices of agricultural land will go up. And because of this, the agriculturists what more not so well positioned, they will suffer, and they will not be in a position to acquire those properties. So that is the also objective. And sometimes the person resident outside India has got no intention to do agricultural activity. They are more interested in doing commercial activity. So they will convert that land into NA, and then they will exploit it for commercial, and then India will use that agricultural opportunity. So agricultural plantation, farmhouse not allowed. Farmhouse also. What is the meaning of farmhouse? If there's a big, huge plot of land and a small cottage, that would be a farmhouse. So land abundant there too. Matlab, you can have a bungalow, but the land should be only what is required to use that bungalow. It should not be disproportionate to the size of the bungalow. So that is what it means. A farmhouse is something where a huge plot of land, a small bungalow, small cottage at one end, that would be constituted as a farmhouse, whereas a bungalow is a residential bungalow would be a different bungalow. A foreign spouse of NRI PIO can become a joint owner, cannot exclusively own the property, but since our NRI or PIO is married, or OCI has married a foreign citizen, now that person can become a joint owner, but not an exclusive owner. Now, see, there is an exception to the agricultural rule. As I said, agricultural property cannot be acquired by NRI or OCI. But let's take a very practical example. There is a resident person in India who is a father, and he has got his children who are outside India studying or working or whatever outside India in US or something, and they are non-resident. Now, this resident father has got huge agricultural property, and suddenly now he is on a deathbed and he's dying. So what happens to his property? What happens to the agricultural property? All his children are outside India. Do you mean to say that property will go waste? Nobody can take it? No. In that situation, foreign non-resident Indians and OCI can inherit agricultural property, but they cannot acquire. See, the wording is acquirement, they cannot purchase, but they can, of course, inherit. Now, again, there is a condition. Now, they have somehow got inherited agricultural land. Now, they want to sell this agricultural. They cannot sell it to NRI or OCI because NRI or OCI cannot buy it. They can only sell it to a resident. They cannot sell it to a OCI or NRI. A resident can give property other than agricultural to NRI or OCI. So, a gift is allowed, but not of agricultural property. Agricultural property can only be inherited by a non-resident, not acquired by way of gift. So a resident cannot even gift agricultural property to NRI or OCI. But yes, a commercial property or a flat, something that can be gifted by a father to a non-resident children. NRI can gift any property to resident because when they can sell to a resident agricultural property, they can also gift agricultural property to a resident. So that is allowed. Remittance, sale of property, security, amount brought in by way of inward remittance from outside India for purchase of property can be remitted outside India, no questions asked. Whereas as far as the capital gain is concerned, there is a little bit of a question mark. See, there is a little doubt. Earlier, the provisions under the property acquisition was very clear that only what you can remit out was what you had brought in. Okay. But now under the new non-debt rules, there is a little ambiguity, which says that yes, whatever sale proceeds are there, you can remit out of a property. Still, apart from that, there is another thing is that 1 million. So even if you are in a position to remit the cost outside India under the normal scheme, but the capital gain can go under the 1 million scheme after payment of taxes because that is allowed. There is no prohibition there. Remittance of only 2 residential properties is permitted. Suppose if you have got, if a non-resident Indian or an OCI is owning residential properties, they are owning, let's say, 3 residential properties, they can own. But when they sell 3 residential properties, they can only repatriate only to the extent of 2 properties. You cannot repatriate the 3rd property. So this is a condition for that. Okay. This is under FEMA non-debt securities regulation. In respect of security, there is a separate regulation acquired out of inward remittance on a repatriable basis. Sale proceeds net of tax can be repatriated, remitted out. No conditions on that. Now, DTA and tax, I have already explained to you that 15 CA, 15 CB is required for any remittance out of India. So when a person is preparing 15 CB, the chartered accountant, he has to see the various provisions of DTA. When apply whichever is beneficial. If Income Tax Act is beneficial or DTA, whichever is beneficial, he can apply. So generally, DTA is beneficial because now what is a DTA? What is a double tax avoidance agreement? Now the countries both agree. Now 2 countries come together and make an agreement. Okay, look, sometimes the income is taxed in one country because of residence and in another country because of accrual. For example, if a person who is a resident in India, his world income is taxable. Suppose if he has got some income in US, he has got some investments in US, he's got some property in US, and he is getting some rental income. Now, India will tax the world income because he's a resident in India. So that US rental income is taxable in India, but the US also will tax rental income because it is accrued in US. So there is a double tax. Now the loss, the DTA says, okay, there will be a sharing of tax. So suppose the tax in US generally is about 28%. In India, the tax on rental is around 21%. Why 21%? Because you get 30% deduction. So if it's 30% tax, you actually effectively pay 21%. So now in India, 21% tax has been paid on the same income, rental income. But in USA, there is no question of 30% deduction. You will pay tax at 28%. So 7% he will pay in US and 21% he will pay in India. So the 21% tax, whatever he has paid in India, he will get a set off in US, and US only 7% will be the outflow. So effectively, he will pay whichever is higher. So he will pay 28% of effectively on that income. He will not pay 28 plus 21, but he will pay which is 28%, which is the higher of. So 15 CB is an auditor certificate to mention the tax deduction. Then there is something called make available concept for technical service. Now, if you look at a Singapore and India DTA, there is a provision of make available. Now, what is the concept of make available? Suppose, for example, an architect sitting in Singapore is preparing some drawings or plans for a company in India to be used in Indian project. Now, Section 9 says there's particular income, particular money which is being paid to the architect. That money, that income is now that is being used by the whatever services he has rendered is being used in the project in India. So it is by default, it is accrued in India, accrued and realized in India. So they're taxable in India. But the DTA of Singapore and India says if the services of that consultant is such that there is no make available fund. What is the make available? That consultant is making a drawing and giving it to you. He's not teaching you how to make that drawing. If he is teaching you how to make the drawing, and suppose, for example, he has made a drawing for project A. Now you are in a position to make drawing for project B also based on whatever he has taught you. Then he has made available the technology which is there. So then in that case, the income will be taxable in India and you will have to deduct tax at source. But if that architect is only giving you the drawing, he is not teaching you how to make that drawing, then you cannot. And suppose for project B, again, you have to go to him. By you make drawing for my project B, you cannot make your own drawing because you don't know how to make the drawing. He knows. So in that situation, it is not make available. And if it is not make available, then in that situation, TDS does not apply in India, but TDS applies in Singapore. The tax applies in Singapore and not in India. So these are all these things. And limited of benefits clause also is there in various countries like Mauritius. Now I'll give you a very simple example of this Mauritius. Now, if you look at when the FEMA opened up and these foreign investments were permitted, the floodgates of foreign investment started. And people started doing treaty shopping. Okay. And Mauritius had a very favorable treaty with India. In the DTA, it was the most favorable treaty. Now, what was the treaty? See, if you look at now, for example, a foreign company has invested in a shares of an Indian company. Okay. And after some time, then actually they want to exit and they will sell these shares to some Indian entity. They want to exit. At the time of exit, there could be a huge amount of capital gains. Now, we all know that when the shares are of Indian company and owned in, located in India, the company is located in India and the shares are of Indian company, it 100% accrues in India. The tax capital gain accrues in India. No doubt and debate section 9 is applicable. Now, as far as Income Tax Act is concerned, the tax applicable in India. But now when we say we have to look at the DTA, now DTA or whichever is beneficial, income tax or DTA, whichever is beneficial. Now Mauritius treaty says capital gains on shares of an investment wherever located will be taxable in Mauritius. That is what the treaty says. So now the tax which was liable in India shifts to Mauritius. Very, very clear because of the DTA. Now, if you go to the Mauritius Income Tax Act, there is no tax on capital gains. So what happens is, I have seen cases where thousands of crores of capital gain accruing to a foreign company in India on sale of shares has gone tax-free because of the Mauritius treaty. Now, how would the people do? What the people were doing? They were US companies, the investors were from various other countries like Singapore, US or any other country. They will open one account in Mauritius, and I had happened to visit Mauritius on a holiday. And when I was doing this foreign investments for various clients, and I saw that a lot of investment was coming from Port Louis, and there was one street and one building which was mentioned in all the addresses. So I was a little fascinated. I said, when I go to Mauritius, I will go and visit this particular street and this building, because all the investment, thousands of crores of investment coming, and all the addresses were all this one street and Cassette Street or something. I forgot the name of that street in the building. Then when I went to Mauritius, I made it a point to go to this Port Louis. I went down to the street and I went to this building and I saw that this building is been basically housed by all lawyers of Mauritius. And these lawyers used to incorporate these companies for various clients outside from various countries outside India, outside Mauritius, US or Singapore or wherever. And they would be the managers of that company. None of those directors or somebody would be sitting in Mauritius. They are the managers of this particular company. They will open an account. They will be having a power of attorney to do everything. And the money comes in from the US to that Mauritius bank account for a minute and immediately leaves for India to invest in that shares of the Indian company. Now, and that Mauritian company entire thing was managed by that lawyers, but of course, the shares were held by that foreign company, so naturally they were the owners, but managed everything by these lawyers. So, and I saw that this was just a pass through, and just to get the benefit of the treaty. After many years of such thing, there was a huge UN cry, and there were a lot of public interest litigations, and one judgment of Supreme Court came up, Azadi Bachao Andolan. And after that, the Mauritius Treaty was revised and revisited. The Indian government revised the Mauritius Treaty, and there was a business purpose test, principal purpose test was introduced, that you need to have an office, you need to have a staff, and you need to have some operating expenses of that company in order that Mauritius company can invest in India. You cannot have just that lawyer's office and working like that. No, it is not allowed. And that all the treaty benefits were not available unless and until this principal purpose test was established. So that thing, the lacuna which was there, that loophole which was there was plugged. And those companies necessarily had to set up an office in Mauritius, take up an office, have some staff, get that money into that country, and then bring the money into India. So they had to do some activity in Mauritius to qualify for that particular tax exemption. So this is how it is. In business income, the permanent establishment concept is also very important. And unless there is a P, then there is no taxability in India. That is also there. As far as professional cases concerned, there is no such exemption. Capital gains, as I told you, this is what it is, how it deals with. Now we look at the inbound investments, and which are the inbound investments. Inbound investments are of two types: investment in debt instrument, that is all ECB, that is a external commercial borrowing, the debt, or it could be a trade credit. Somebody is availing a trade credit, long-term trade credit, maybe 180 days or something on an LC or without an LC, and that also is covered under ECB. And ECB is the where you avail of foreign loan. Now, many times we feel that, oh, these foreign loans are very, very cheap. They come at 5% or 6% rate of interest, whereas in India, we pay around 12 to 13% or sometimes even more than that to the bank to avail this bank loan. But then we don't factor the foreign exchange fluctuation. When you borrow money, the dollar might be 70 rupees, and when you want to repay the loan, you still pay in the dollar terms, and the dollar might be at 85 rupees. So you pay 15 rupees as the exchange loss, and that might be much, much more than your interest rates. So you have to have probably a proper exchange cover when you are borrowing in ECB. Otherwise, you are exposed to a huge amount of exchange fluctuation. Otherwise, if you have covered all this, then probably it might be cheaper. But then when you take a cover, the foreign exchange cover will definitely cost you slightly higher, and more or less that whatever benefit you are trying to gain from the interest factoring, that might a little bit get diluted. On the other side, when it is a non-debt instrument, there are about nine such options available. Foreign direct investment, that is a foreign entity or a non-resident Indian or an OCI or a pure foreign citizen or a foreign company or an entity investing in the shares of an Indian company. And now here, then there are some sectoral caps. Certain sectors are 100% allowed. Certain sectors have got 49%. Certain sectors are prohibited. Like, for example, if a company is into trading into real estate properties, that suppose he's doing buying and selling of properties, or if he's into agricultural activity, then it is under prohibition law, and you cannot even get an RBI approval for that. So you cannot invest in the. But now real estate dealing, business of real estate does not include. I mean, the prohibition does not include those entities we are doing development of projects. Suppose, for example, a company is engaged into business of development of township or a project, commercial project or a residential project where they want to develop the project and sell to a customer, then that is not covered under a prohibited list, and it is allowed under the automatic route, and the foreign direct investment is permissible. We have done several such FDIs where money has come into real estate sector. Foreign portfolio investment. Now here it is where the money comes into share market, scripts which are listed scripts by a non-resident Indian or an OCI can invest in the portfolio investment scheme. Now, yes, foreign direct investment, which I mentioned, is mainly unlisted entities where a private investment is made by a foreign investor. Investment by NRI or OCI on a repatriation basis. Now here, there is one very interesting thing. LLP, which was earlier not a permissible vehicle for investment in India, only a non-resident could invest in a company. Now they have opened up LLP because LLP is now a very popular form of investment. It has got a mean between the partnership and a company, and it's got an advantage of both. So LLP is also permitted for investment in done by a foreigner or by a NRI or an OCI on a repatriation basis. Now there are certain conditions. If for example, if that particular LLP is engaged in those activities which has got sectoral caps, that means you cannot have 100% investment, or there are performance linked restrictions or conditions that yes, you have to do this, you have to do this, you have to achieve this performance within some time period, then only you can invest. Then in that situation, on a repatriable basis, a foreign company or a non-resident or OCI cannot invest. Then they have to go for a non-repatriation basis. But on non-repatriation basis, only it is NRI or OCI can invest. A foreign company cannot invest. Okay, so that once they come out of, when they exit that LLP, their money remains in India. Money cannot go out of India. Whereas in case of a repatriable thing, the money can go out of India after they exit from the partnership. Investment by other non-resident entities like investment fund, trust and all that REITs, or, those alternate investment funds, investment trust, all these things are allowed under this, the other entities. Investment by foreign venture capital in the Indian market also is permissible, or even in the startups they can invest. Investment by a person resident outside India and India investment vehicle. There could be so many vehicles which are permissible in which we can invest. Investment in an Indian depository receipts. Now, there is a foreign ADR, GDR, or Indian depository receipt also is permissible. Now, what is IDR? IDR is the companies who have, Indian companies, they float their own shares into an IDR vehicle, and foreign investors can invest into that particular vehicle to get that IDR benefit. And IDR can be listed outside India or in India. Foreign direct investment scheme, which is there. Eligible entities where investment can be made is there are eligible entities. Who are eligible entities? Companies. This is under foreign direct investment scheme. LLP is not covered. It is only companies which is eligible. No partnership, no proprietor, nothing. It is only entities which are companies. LLP के लिए separate regulation है that I have already discussed. That there is separate schedule for that, which I have already explained you that LLP there are different conditions. Modes of remittance has to be inward remittance as far as the foreign entity or a citizen is concerned. But whereas the NRI is concerned or OCI, they can invest through their NRE account, not through NRO account. They can remit only through NRE account because it's a repatriable fund. NRO is a non-repatriable fund, so you cannot invest from NRO account. Sectoral caps, yes, there are sectoral caps of various such items. Certain defense they don't want, so there is again a restriction. Railways they don't want, airports they don't want. So wherever they feel that is sensitive sectors, atomic energy is prohibited. So they have given they have not allowed investment in certain sectors which are or they have restricted the investment. Banking also is restricted. So there are sectoral caps, and where there is no, there is a full schedule of sectoral caps. In some of the cases, 100% is mentioned and conditions are mentioned. Wherever there is nothing is mentioned, suppose if there is no name of that particular sector in any of this schedule, then it is 100% allowed without any restriction. Okay. So if there is a name against it, there is a percentage mentioned, then you have to comply with it. Types of instruments for investment, yes. The investment can be only in equity or convertible instruments. You cannot, and compulsorily convertible. This is very important. You cannot have an optionally convertible instrument for investment, because tomorrow you don't convert and it becomes a redeemable, and when it's redeemable, it becomes a debt. So these are non-debt investments, and you cannot have anything which is not, optionally given convertible. It should be compulsorily convertible. You can have a compulsorily convertible preference shares. You can have a compulsorily convertible debentures. You cannot have optionally convertible. Equity share, of course, is equity share. There is no question. Valuation norms have to be guided. Now, there is one very basic principle I will share with you about the valuation. When there is an inbound investment, when the money is coming in, see, there can be two types of such thing. In case of FDI, money comes in initial level. Money goes out at exit level. In an ODI, money goes out at the initial level and comes in at the exit level. Correct? These are the things. Now, the principle is very, very clear. When the money is coming in, whatever is the value which is derived for the share as per the DCF method, discounted cash flow method, you cannot apply book value method or any other method. Discount. Why discounted? The foreign investment, the regulation doesn't say discounted method. It's an internationally recognized method, and internationally recognized method is discounted cash flow method. So we are complying with that. We are following that. Now, when the money is coming in, it is inflow into India. Suppose the valuation of that share comes to 100 rupees. Very common sense principle. The company cannot allot shares at 80 rupees or 90 rupees or 95 rupees or 99 rupees. It can allot shares at 101, 110, 200, 300, 400, 1000. Anything above 100 or 100. But it cannot go below 100. Very clear? When they are exiting, the value is 100. The resident Indian who is acquiring shares from a non-resident cannot pay to non-resident anything more than what is the value. You can pay less, It can pay 99, it can pay 98, it can pay 50 rupees, but it cannot pay 100.1. Very simple, logical, because money cannot go out more than the value. Money cannot come less than what is the value. Very simple, common sense principle. You have to follow that principle. Okay. So the valuations have to be complied with. And valuations can be done by chartered accountants, allowed, permissible. Time limits for compliances, there are all time limits, all because sometimes there is a post facto compliance. For example, any foreign direct investment which has come in, now first the money comes in. Within 60 days, you are supposed to allot the shares. Even in Companies Act, there is a requirement. After that, within 30 days, you are after allotment. Within 30 days, you are supposed to file one form FCGPR with the AD Bank online. It is online filing. So you have to file that form. The moment you file that form, there are some supportings to be attached, valuation certificate, consent from the buyer, from the investor, from the company, board resolution from both the companies, and all those things you have to submit. Once you submit all this valuation and everything, the resolutions and all that, and you have to file online, RBI then gives you an acknowledgement. And when that acknowledgement comes in, it means this particular document has been taken on record. It is not an approval. It is taken on, because you don't need an approval. It is under automatic rule. So it is taken on record. Now, this is very important. Many times we file that paper and we do not wait or do not follow up for the. I mean, you don't have to follow up. Actually, it comes in, but if it is not coming, you have to follow up. You don't get that letter, and once you don't get that letter, and at that time you won't exit. This letter is very important. Without that, the AD Bank will not permit you to remit money outside India, so that your money is stuck in India. Okay, so you just now it is all online. Initially, it was all manual, and you had to submit this paper with the Reserve Bank of India. I'm talking about 2000 and initial years of FEMA and FDI, when we had to submit physically papers through AD Bank to the RBI, and we never got that taken on record letter. We used to get a physical letter from the RBI saying that this particular transaction has been taken on record, and they used to give one number on that. Sometimes after filing, people forget and they don't collect this letter, or they don't follow up for this letter, and the letter doesn't come. At a time of exit, then there's a big problem. You are not in a position to exit and to remit money outside India, and that investment becomes stuck in India, and that foreign investor suffers because he is not in a position to repatriate this money out of India. The reason why that taken on record is required is because when you have filed that form, there could be some queries of the RBI. They could have raised a query, and you have not replied to the RBI query. So then they will not take it on record, and that letter will not come. So there is a possibility that there was some non-compliance. You have not complied it correctly, and RBI has raised a query, and you are not complied with. So based on that, that money becomes non-repatriable because you are non-compliant with FEMA, and then all the penalty proceedings and all that will start. So you must also make sure that this whatever, suppose if there is any query from RBI, immediately respond to it, clarify, and then get this letter taken on record. Now it is all online, so you should get it online. So this is the process and compliances which I mentioned to you. Once you have done that, that compliance is over. No further thing is required. You have to ensure that Companies Act compliances of allotment of shares and everything has to be done. You have to comply with it. FDI eligible entities and mode of remittance, I told you, companies registered under a Companies Act, LLP under certain circumstances, not under FDI, but under a different scheme. Mode of remittance by inward remittance to banking channels. Or if it is an NRI, he can give money to NRE account also is allowed. Now, FDI list of prohibited sectors, lottery business, I told you, is not allowed. Gambling, trading in transferable development rights, TDR is not allowed. Manufacturing of cigars, cheroots, cigarettes, all this is not allowed. Needy companies, these are those dealing in financing and all that. Real estate business, I told you, or construction of farmhouse, but this real estate does not include development of projects. So any residential projects or commercial projects are allowed. They are not in the prohibited list. Sectors not open to private sectors like atomic energy, railway operations, other than permitted activities are in the prohibited sector. The sectoral caps are under, there are two routes, automatic and approval, where there are under sectoral caps. If you are complying within the sectoral caps, then you don't need any approval. But suppose if there is a sectoral cap of 49% and you want to allot shares of 51%, then you have to go to RBI for approval. If it is in a prohibited list, RBI also cannot give you approval. Even central government cannot give you approval. So you cannot do anything. But as far as sectoral caps are concerned, if it is under 49%, then possibly you can get some approval. Types of instrument, I already told you: equity shares, compulsorily convertible preference shares, convertible debentures. Debt instrument like redeemable debentures or preferences not allowed. Valuation norms, I think I've already explained to you, so I did not go into it further. We have to also ensure 56(2). Now 7B is gone because now that has been removed from the income tax act, so we are not considering it. Time limits, I have already told you. Shares to be allotted within 60 days, and within 30 days, FCGPR has to be filed. If there is a transfer of shares from one shareholder to another shareholder, then you file FCTRS. That is Form FC for transfer, and that is within 60 days from the date of remittance. FDI process, I have already explained to you. We have to file Form RBI online through RBI Forms portal. First, we have to create the entity user, like how we create user in income tax. We have to create user ID and business user. Needs to be created on RBI Forms portal. Then address of the website is forms.rbi.org.in. RBI has launched new filing single master form. In one form, you can file all types of form under one single umbrella. FCGPR, FCTR, LLP1 is when the money comes in. LLP2 is when the money goes out. Form CN is for the notes. And form ESOP is there. Form DRR is there. Form invest. These are all different kinds of investments. It takes 1 day to accept the login and confirmation email received from RBI. On remittance from investor, KYC is important. KYC from the remitting bank is required because they should know who is the investor who is remitting in India. The RBI should know who is the remitter. Amount should be received in convertible foreign exchange. Shares or instruments are required to be allotted within 60 days. That is what I mentioned. Now, these are the forms which you have to be filed. Form FCGPR is in respect of any investment in Indian equity. And Form FCTR is when the shares are transferred to a resident. Or initially also when, suppose, instead of getting allotment, if there is a transfer of shares, then again FCTR has to be filed. LLP1 report filed by LLP, which is received in FDI as capital convert. LLP2 is when the money is exited, when they exit the partnership. CN is the convertible notes. And ESOP, if there is an ESOP to an Indian, to a foreign director by a foreign employee by an Indian company. Form DI is the downstream investment. Suppose if there is any investment in India, a foreign company has invested in India, and now this Indian company is making an investment in another Indian entity. Now that amounts to a downstream investment, and that also is required to be reported. So under Form DI has to be filed because it amounts to an indirect investment. Like that foreign entity could, like for example, suppose now that one company X Private Limited is operating in India. Now a foreign entity is investing in X Private Limited. Now X Private Limited goes and invests in a company which is under a sectoral cap. So where a foreign investment is not allowed. And now this entity goes and invests in that company. So indirectly it has allowed a foreign investment in that company, which is a breach of FEMA. So that is the reason this DI form is required to be filed, where DI will say that yes, this particular company where he is investing is also eligible under FEMA. Otherwise, it cannot, that private Indian company cannot invest in that other company because there is a foreign investment. Otherwise, it amounts to contravention of circumventing the FEMA law indirectly. The depository receipts, any transfer, then it is Form DRR. Any investment vehicle, then it is Form Investment 1. We are a little short of time. The subject is pretty vast, so I'll need to move to more little fast. FCGPR filing, I have already explained to you what are the requirements. You need a KYC of that person. You need FIRC, foreign inward remittance. It should mention very clearly that it is for acquisition of share. You should not be loan given, this, that. It should not be something other than what is the purpose. That is the shares or convertible debentures or convertible preferences. It should not be anything other than what is permissible activity. Then valuation report, declaration by investing. Now, if it is an initial allotment of shares, suppose the company is just formed and there is no, at the time of subscription, if there is a foreign investment, then you don't need valuation because there is no question of valuation. Certificate from the company secretary for compliance that it is complied with FEMA. Resolution for allotment of shares, memorandum of articles of association, that also has to be attached. All this has to be filed along with the Form FCGPR. After submission of form will be auto acknowledged, and you will get a 5 working days, you will get one acknowledgement, and that acknowledgement will give a number which says it is taken on record. Unless there is a query, this will be generated. If form file with delay, yes, you have to file an LSF. That is a late submission fee. Suppose after 30 days you file this form, then you have to file an we have to pay some LSF, late submission fee. Now, FCTRS is where there's a transfer of shares. After 60 days, within 60 days from the transfer of shares, you will have to file this form FCTRS. Again, similar documents have to be submitted with the login. And it's again online filing. Outbound. Now we will go into very quickly into outbound investments. Now, what is outbound investment? Is for investment in subsidiary, joint venture, associates outside India. Financial commitment is allowed by a foreign, by an Indian entity outside India. You can have a pledge, you can have a guarantee, you can give a loan. And first, of course, you have to be a shareholder. Without being a shareholder, you cannot do anything. You can't give a pledge, you can't give a guarantee, you can't give a loan. Now, loan again has to be at the interest rate, which is at arm's length price, which has to be at the market price of that particular country. Suppose in that country, the arm's length price is 10%, and you have to comply with 10%. You cannot give at a 9% or 8%. So that loan, you have to be very careful how you are giving. Now, they again banned investment in certain sectors like real estate, trading in TDR. Again, real estate will not include project development. So if it is just buying and selling of land in some US, then you can't invest in that overseas investment. All entities except proprietors firm can invest. Individuals can also invest, but not under overseas investment rules, but under LRS. They can go under LRS and invest in the overseas investments. An automatic and approval rule, again here, same thing. If you're not complying with the conditions, now what is the limit up to which a person, an Indian entity, can invest in a foreign investment? Up to 400% of the net worth of the, as per the latest audited financial statement. Now, here, this is very interesting. I want to share some practical insights of this. Now, what is the meaning of audited financial statement? Now, I'll give you an example. Let's say a company has just been formed. Let's say in October 2024, a company has been formed. Now, in January, they want to acquire some company in Singapore. Now, they do not have a previous financial year. They don't have March 23 or March 24 to have the financial or audited financial statement. So how do you mean to say they cannot invest? No, they can invest. What they will have to do is make an interim financial statement, but that has to be audited. Very simple. It doesn't say annual audited financial statement. It says audited financial statement. So you can make an audited financial statement as on a date which is prior to the date of the investment. Suppose, for example, 31st December 2024. Audited financial statement can be made. Work out the net worth as per that audited financial statement, and 4 times that net worth you can run it. Now, again, very interesting. What is the net worth? The net worth is as per the accounting standard which is applicable to that company. Now, suppose there is a company where accounting standard, which are normal accounting standards, are applicable. In some cases, Ind AS is applicable. Now, we are all aware that in Ind AS, redeemable preference shares is not a part of net worth. Whereas in case of a normal accounting standard, redeemable preference shares is part of net worth. You have to show as capital. Whereas in the Ind AS, we don't show redeemable preference shares as a capital, but we will show it as a debt because it is a debt. Now, to work out this net worth and work out at 4 times that net worth, 400%, you have to go as per whatever is the net worth as per the accounting standard which is followed by the company. Suppose if it is under Ind AS, and now there is, let's say, for example, the company has got a equity capital of, let's say, 10 crores, and it has got a redeemable preference shares of, let's say, 20 crores. And since it is a new company, there is no other reserves or something. So now it has made a balance sheet under Ind AS. So his net worth will be 10 crores. So it can only remit up to 10 into 4 times, that is 40 crores. It cannot remit more than that. Although it has got another 20 crores by way of redeemable preferences, it cannot remit more than 40 crores. Now, suppose if the same balance sheet was prepared under accounting standard, which is not under Ind AS, now the net worth would have been here 30 crores. It can invest up to 120 crores. So this is a difference. Now you have to go whatever you, there is, the net worth is as per the Companies Act, not as per any formula worked out as per the FEMA, but you have to go as per the Companies Act. So this is very interesting. Net worth includes share capital, reserves created out of profits, and share premium. Okay. Cannot invest in countries that are under non-cooperative mode as per FATF. Now, there are certain they've identified certain countries where investment is not permissible. The reason is they are encouraging money laundering. Okay, so those countries are under FATF, and that countries are not allowed to be remitted. Now there is a site on which you will get this FATF details, and you have to see whether that particular country where you are investing is under that particular country or no. For example, North Korea is there, or there are so many other countries who are non-cooperative and they are part of that particular list. And it is also some African countries are there, some tax havens are also in that list. And you have to ensure that when you are making remittance, this list keeps on changing. They keep on adding to the list or they're removing from the list. So you have to ensure, when now as a chartered accountant, you are supposed, as a statutory auditor, you are supposed to certify that when ODI is being made, that all this is complied with 400% net worth, all these regulations, that arm's length price if it is a loan, all that you have to comply. Now that 400% which I told you includes prior investment. Suppose, for example, it has already made some investment earlier and now it is making further investment. So that all put together, whatever is investment outstanding as on date, together should not exceed 400%. Suppose, for example, it is in year one, it has made investment of, let's say, 10 crores. Now it wants to make another further investment of 20 crores. So total 30 crore must ensure that the net worth is more than 7.5 crore. Otherwise, they cannot make investment of 30 crores. So this is very important. On the date of investment of further 20 crore, they should ensure that the net worth is 7.5 crore or more. Then only they can invest 30 crore. They don't have to look at 5, but at least 7.5 minimum. So you have to also see whether that company is under an NPA. Suppose if there is an NPA, there is a bank default, then they have to take an NOC from the bank. Otherwise, they cannot make an overseas investment. The reason is very logical. एक बार जो default कर रहा है और उधर जाके invest कर रहा है, तो that is not permissible. So they have to take an NOC from the bank. Suppose there is the bank has classified them as a willful defaulter. You have to take a NOC from the bank. Otherwise, you cannot make an investment. Suppose that company is under investigation by ED or a CBI or any agency, any government agency, then therefore they cannot invest unless they get an NOC from that agency. If NOC has not been received, once you apply and you don't get the NOC within 60 days, it is deemed to have been granted. So there is a deeming provision. Okay. Now, once you invest in a foreign entity, it is a compulsory, it is a requirement of the company to ensure that a share certificate of that investment has to be brought in within 6 months and submitted to the, copies of that has to be submitted to the RBI through AD Bank. Okay, we have to submit this to the AD Bank. In case of the liquidation of that overseas investment, the funds have to be remitted back to India. Now, ODI process is very simple. Create unique identification number, file one Form FC with the AD Bank. Form Schedule E, which is the main thing, is certificate by a statutory auditor that it is all compliant with all the things. Check financial action task force, which I told you, FATF. You have to check that particular status that is on this particular website. FATF list out those countries I told you. Bank approves ODI form and then permits remittance. This is the pre-remittance approval. Approval in the sense that it is under automatic route, but whether you are compliant with ODI rules, they will check and they will permit. Form A2 is to be filed. And again, you have to see whether any tax and all that is required to be paid. All remittance to one branch of AD is required. So every year now, every year till the investment process, you have to file annual performance report. I told you APR has to be filed and APR has to be certified by a statutory auditor. In case of multiple investors from India, the highest investor will file. Suppose if there are 2 investors in the same company and one is holding 55% and one is holding 45%, then the person who is holding 55% will file and the 45% will not file. Okay. So, and if they are both are 50-50, then both will jointly file. Okay. APR is required to be filed by statutory auditor. Now, again, there is one very interesting thing that the control is defined at 10%. Now we know control is 50, more than 50% is control, but for the FEMA and ODI, they have defined control at 10%. So suppose if any company in India is holding more than 10% outside India, now when filing APR, you have to obtain audited accounts of that overseas company. Now it is quite possible that in those host countries, like in US, the audit is not mandatory for all the entities. Only about certain transaction, about turnover, about certain capital, the audit is mandatory. Even if audit is not mandatory, they will have to get it audited. Even Indian chartered accountants can audit a US company. So that is also possible. But audited accounts are required. So by December 31st, when you are submitting the APR, you must ensure that audited account of that entity is available. Otherwise, the APR cannot be filed. The bank will not accept it. LRS scheme, I have already explained, 2,50,000 for acquiring property outside India, acquiring shares of a listed company abroad, opening bank accounts outside India, an entity. Now, one thing you must be very careful, and you must know that when you have got investments outside India, you must disclose this in your return of income when you are resident, because foreign assets disclosure is mandatory under that new law, black money law, and that is mandatory under Indian Income Tax Act and the rules. So you have to disclose this under your income tax return, and non-disclosure can entail a penalty of 10 lakh rupees. And not only that, if there is an income which is accrued on that particular thing and you are not disclosed, and then it amounts to prosecution also. So this is very serious. You must ensure that. And even not only you have got investment, but suppose you are a signatory in the bank account. Suppose you are a trustee or some investor. I mean, somewhere you are a director on that foreign company, and you are only a signatory in the bank account. You are not at all having any account or your account, but it is that company's account. Even you are a signatory, that also has to be disclosed, and peak balance have to be mentioned. FLA, foreign assets and liability returns, have to be filed every 15th of July. Now, who have to file? See, as I told you about APR, only when there is an overseas investment, you have to file. When there is an inbound investment, APR is not required. Now, FLA is required for both. When there is an outbound investment or inbound investment, FLA is required. Now, when you file FLA, you have to give particulars about your foreign entity, in Indian entity, everything you have to give. But you also have to give, suppose if you have got debtors, trade debtors, other than your investment. Suppose you are doing some exports and you have got debtors in which are in foreign currency, you have to disclose. If you have got imports and there are foreign suppliers, foreign creditors, you have to disclose. But you just have foreign debtors and creditors and no investment, then don't need to file FLA. If you don't have an inbound or outbound investment, only you might have debtors and creditors in terms of trade debtors and trade creditors, you don't have to file FLA. But if you have those inbound and outbound investment, then file for an FLA and disclose even the debtors and creditors of import and export. That is then it becomes mandatory. Now, export of goods and services, this is very important. Many people don't know they are exporting software. They do ITES services. They render services to a foreign entity in terms of ITES. They are required to register with STPI, local STPI. It is mandatory, and they are supposed to prepare soft text form, submit for approval before they send it to the customer. Their soft text form has to be approved by the STPI and worked out in arm's length basis. They will check whether the pricing is as per arm's length, the rate for hourly rate or something. You're supposed to give the type of services that you are rendering, and they will compare with other norms, and you have to explain why it is at arm's length price. And then when they approve that soft text form, then only you can send it to the customer. And then you have to realize the money within the timelines and then inform STPI. They have to file some forms, some returns also with the STPI. Quarterly returns are there, and then there is an annual return also. Export relation to be reviewed within 9 months from the inconvertible currency. Any write-offs is there, that is a procedure. If it is within the limit, a CA can certify and approach you can write it off. In case of delay, apply for extension. I told you if there is a delay. Now, this statutory auditor is supposed to see all this. Even though there might not be an overseas investment, there not be any FDI. But if there is an export relation delay, then he is supposed to verify all this. The last topic, and then probably we will open it up for the questions. Compounding and penalties. Like whatever I mentioned, FEMA has been liberal as far as allowing money to come inside India. Crores and crores of rupees, millions and millions of dollars have come into India. and it has, improved the Indian trade. It has improved the Indian economy. And similarly, Indian businessmen have invested outside India and expanded their businesses, and they have been able to get the benefits of the international trade. All this is fine. But if you have not complied with the regulations, and if you have done something which is not permissible and not within the framework of law, then it will attract compounding penalties. Now, what is the compounding? What is the difference between compounding and penalty? Penalty is when the department finds out and they issue a notice on their own by way of an adjudicating notice, and then you have to represent, and if you are found guilty, then the penalty of up to 3 times the amount involved is levied. Okay, that is one part. Where you yourself on your own, when you realize, oh, I made a mistake, I didn't know this, I by oversight, I made a mistake, and I have done something which is a non-compliance, I can approach Reserve Bank and say that, look, mera galti ho gaya, please, I want to go for compounding, and RBI will then look into your case, and if they feel that yes, it is a genuine error, and they will be able to work out what is the benefit you have taken out of that, and then on that basis they will do some compounding fee, which is much lower compared to what you would have paid as a penalty 3 times. It would be something 0.25% or 0.5% of the amount involved. So you will get away with a very smaller percentage of penalty or a fee. If you go on your own, suo moto, and tell RBI, look, with a folded hand, that galti ho gaya. But compounding orders are not appealable because naturally you are going with a folded hand. Similar happens with the TDS prosecution matters also, where you go for compounding and those you pay the fee and then prosecution is waived off. Here, of course, there is no prosecution, but then penalty is not levied, and you are in a position to come out of it with a very small fee. But then compounding can be done only once or twice. You cannot keep doing it, otherwise it becomes a habitual. And again, this has to be done within 3 years. After that, the penalty will be applicable. So there are various procedures in that. There are hierarchy. Who hears your compounding application? If the amounts are much higher, it goes to the ED. If the amounts are lower, it goes at the RBI level. So this is how it works, and they decide about the compounding fee. So this is as far as the FEMA insights are concerned. If I try to cover the basic broad structure of the FEMA. If you have any queries, I will be glad to take it up.
Thank you, sir, for sharing your knowledge and experience on FEMA provisions. Goala sir has covered each and every aspects of the FEMA provisions in depth. Still, if any attendee member has any question or query regarding any point, it may be asked into this section. So it's time to take some questions already posted on the portal. So, sir, can we take the questions?
Yeah, sure.
Sir,
I can't see those questions. I mean,
yeah, actually, I have available that questions.
Okay.
Sir, is it must to convert a saving bank account held by an individual once he become non-resident to NRO account?
Yes, 110%. As I mentioned to you, when he leaves India, he becomes a non-resident. Suppose if he has left India for a job, for a business, or for uncertain term, he becomes a non-resident Indian. He cannot have ordinary savings account or ordinary current account in India. He has to convert this into either NRO or NRE account as per his choice. An NRO account, it is local money can go in. NRE account, foreign money will come in, and it is a fully repatriable. I explained the difference between NRE and NRO. Non-conversion is definitely non-compliance of FEMA. And another thing, the reason why it is required, why? Because NRE and NRO account are monitored account by RBI. Any transactions in NRE and NRO are reported to RBI, and RBI is keeping a close watch on what transactions are going through in NRE. And your savings and current account are watched by income tax, but RBI is watching NRE and NRO. So if you have not converted, then that goes outside the watching, observation of RBI, and that's where the penalty comes.
Sir, the next question is, can a person of Indian origin who have not obtained OCI status acquire land in India?
Very nice question and interesting. Earlier, a PIO status was recognized. And subsequently, they have amended that PIO and PIO has been deleted. And instead of that, it has been replaced by OCI. Now, see, earlier, there was one separate regulation on acquisition of property where the word PIO was used. That acquisition of property regulation has been removed and replaced by non-debt regulation. And that in non-debt regulation, they have used the word OCI only. OCI is Overseas Citizen of India. And Overseas Citizen of India is only one who is registered with the government and who has got an OCI card. So no, if it's only a PIO without an OCI card, we cannot do it.
Sir, some of the members are asking about the PPT sharing. So
yeah, I'm okay with it. I'm perfectly all right.
Okay, sir. And next question is, sir, if rent is payable to NRI, how to identify whether account is NRO or NRE account?
Yeah, very interesting. Suppose a person who is, let's say, NRI has got a property in India, and it is renting it out to a local person, naturally. Now, when he's making an agreement, in that agreement, he has to write Mr. Now, his name is in Indian. Now, that person who is a tenant will not know whether he is a non-resident unless he actually knows that he is a non-resident. He might not know. Okay. So, the person has to write whether he's an Indian inhabitant. He might give a local address and this tenant might not know. So then it is not a fault of the tenant when he doesn't deduct TDS as per 195. He might deduct TDS as per 194 or whatever section as per resident. So it is the duty of the non-resident person also to inform the tenant that yes, I am a non-resident person. By way of in the recital, you should say that I am a resident of so-and-so country and my address is so-and-so. And then based on that, he will deduct TDS as per 195. And even the payment which he will make, he can issue a check or something which can be deposited either in NRO account. Then there is no 15CA, 15CB required. The money can straight away go in NRO account and TDS has to be deducted as per applicable 195 section. But when he wants to deposit in NRE account, he has to comply with 15CA, 15CB. I told you, there is the immigration clearance he has to do. Whereas in money going into NRO is before immigration, so money can be deposited. But once this person now, non-resident, wants to transfer from NRO to NRE or outside India, then 15CA, 15CB is up.
Next question is there a limit to how many NRIs can buy property in India?
No, there is no limit as far as number of properties one can buy, but there is a limit on number of properties, residential properties which can be repatriated outside India. That is true. But otherwise, there is no limit as far as NRI can buy 100 properties. There is no limit.
Sir,
only agricultural property not allowed.
Sir, in case of ODI, whether valuation is required at each time ODI transaction taken place?
Yes, yes. There is a validity of a valuation. They will not accept a valuation which is more than 90 days old. Okay. So suppose, for example, I have done an ODI, let's say on 1st of December, and I want to do another ODI in 1st of January, I can use the same valuation. But if I am doing after 90 days, then I need another valuation. Valuation is not valid after 90 days.
Sir, if an NRI purchases an agricultural land by giving his Aadhaar and PAN without mentioning his residential status,
he is violating FEMA.
Now, what will be the
3 times the penalty, and it is a prohibited item, so it will be a very strict action.
But, the question is that what will be the treatment of such property, whether such purchase will be void or it will be taken over by the government?
No, see, I'll tell you, in under this particular FEMA, this kind of confiscation of property or such things is not there. But of course, he will be slapped with a penalty of 3 times the amount, and it will be huge. And of course, he will be defaulter and he will be put under caution list. Now, once he's in a caution list, he cannot do any foreign exchange transaction without the approval of RBI.
Yeah, so last 2-3 questions are there.
Yes, no problem.
Is investment in partly paid shares of foreign subsidiary allowed? Up to what timeline we have to convert these partly paid shares to the fully paid shares?
Very nice, good question. Earlier, deferred payment was not allowed. Partly paid was not allowed. Deferred payment is partly paid is deferred payment, because you suppose, for example, there is a share of 10 rupees. You can pay 2 rupees now. I mean $10, and $5 you pay now, $5 you pay after some time. That is allowed now, and 180 days is the maximum time under which you have to pay the balance amount.
Sir, is it required to convert the SB account of a student go abroad for studies to NRO account?
Yeah, very interesting question. Now, earlier, a student was not considered as a person resident outside India because he was going for studies. And when he is going for studies, he is neither taking an employment, neither is taking a business, or there is no intention to stay abroad for a permanent life, right? That is, so he is outside those purview. But then there was a circular from the RBI and the ministry saying that student who is going outside India is considered as a person resident outside India. And the moment he is treated as a person resident outside India, all the provisions of FEMA will be applicable for a PRO. So then he will have to convert that his savings account into an NRO account. The reason is why this was brought in, because the students sometimes they also do some earnings part-time. They take up a part-time job. So when they are a person resident outside India, they can do everything. But if they are resident, they cannot take up a job. Plus, they can have freedom of remitting money outside India, whatever, all those freedom is available as a non-resident. And that's the reason they have allowed. They can open bank accounts outside India. All that can be done.
Sir, thank you, sir. Last question of the session, sir.
Yes.
Sir, whether any filings are to be made for ESOP issued by the Indian company to NRI?
Yes. I have mentioned, no, there is a form, ESOP is there.
Form A.
Yeah, that we have to file.
Okay, sir.
And again, there are norms in that. There are rules. You have to comply with those rules.
Sir, one question is left. In the case of an individual, not a company, incorporated a company in USA, are they required to file APR?
Yes, see, I'll tell you, an individual who is allowed under LRS scheme. So he will have to comply with the, now this LRS also has the investment, which also has come under overseas investment rules only. So APR is required. Yes.
Sir, thank you, Govawala sir, for such insightful session on the provisions of FEMA. Your expertise has provided immense clarity on this significant legislation. And I'm sure all the attendees have found the session very insightful. I am also thankful of the Committee on Commercial Laws, Economic Advisory and NPO Cooperatives of ICAI for providing an opportunity to act as a moderator of the session on insights on provisions of FEMA. Hope all you have gained such knowledge. Thank you.
Thank you very much.
Thank you, sir.